everybody. It is February 1st. This is the weekly review where we try to look at what happened last week and look at that from the perspective of what does it tell us about the coming ones. And, last week pretty negative. If you remember last week, it looked as if we may get that breakout to the upside. Not happening, right? Big move to the downside. That makes it about the same amount on the yearly. So pretty much all the losses for the month and the year were last week. And a lot of times, failed moves lead to fast moves, and we'll talk about that here in a second. But we definitely saw some pressure to the downside. And I remember specifically saying we weren't out of the woods yet. We were waiting on a confirmation in the S&P 500 to confirm what we were seeing in the NASDAQ and the NDX. Didn't get it, and we ended up taking a big spill to the downside as a result. So what really drove that? Well, a big part of that was Wednesday's Fed meeting, where they didn't even acknowledge the deflation risk due to this dollar strength. That was a real problem. The volatility continues, and these safety fear plays continue to attract money. So, if we kind of look quickly at these three, the dollar strength is really a issue. And I'm not going to say it's bad or good, just that it is affecting these markets. Here's the UUP. You can see it's up here hanging at the highs. Got the one sell-off and then right back up. Nothing happening there. You're seeing continued movement into safety plays. Here's the bonds. New highs, new volume on highs, your higher volume on the highs. And then gold. Gold tried to sell off, right? Came back into support. Didn't quite make it to that gap we were looking for. Flipped around, right? Heading back up towards the highs. Got volume on it on Friday as well. So if we look at any of those safety plays, they're attracting money. And that's leading to increased, volatility in these indexes. I mean, look at the kind of volatility we've seen here, back and forth. Each and every week, it's been like a unidirectional move. You have one here, you have one there, right? Just up and back, big volatility, big wide price spread bars, and it's continued, and it hasn't slowed down. That was all month long. Matter of fact, the last 6 weeks now of this increased volatility, and with the Fed not acknowledging any kind of deflation risk with the dollar, that was this big sell-off you saw on Wednesday. Tried to spike back up on Thursday, but as I told you, I think in the notes, it looked to me like we're going to continue that pressure, and that's exactly what we saw on Friday. And we also saw some volume escalation on Friday. The other big thing that happened here is that structure that I've been talking about, the potential for a faster move down is in place now. And what I'm talking about, and if you've been watching my notes, you know what I'm speaking of, and that is that you got a swing point low here, another one there. You can see it up here for this bar. Those two swing point lows on this time frame mirror the swing point low now. They're not so much mirror it, but they complement the swing point low now that has printed on the weekly chart. And so if you take that price point, right, this area, right, that is going to be an issue if it breaks. And it's going to be an issue in that it's going to lead to a faster move, and I suspect it's going to lead to a faster move back down here to where we see support on these time frames. So when I look at the structure that's in place, the way we traded last week, and internally at some of these other sectors, and I'll talk about that next, it looks to me like, it has a pretty good chance now of trying to break down and get back to this high volume bar. Remember, there's a high volume low down here from October where we reversed and came straight back up just like we have so many times before. It looks to me like we're going to come back and try to test into that thing now. That high is 1912. As of Friday, we're closed at 1994. So in other words, 82 points more to the downside potentially on a faster move if that breaks. And that's the danger that's sitting out there waiting on this market. Now, what might cause that to happen? And what can we watch for to tell us if in fact it is going to happen? And I think there's three key sectors that if you look at the sectors, and matter of fact, let me pop up this. If you look at the weightings in the SPY, your big weightings are in three sectors. And those three, and this changes over time, but those three right now: financials, technology, healthcare, right? If you add those up, you're looking at, what is that, 32, 40, almost half the percentage in these three. So when you think about it, half of the weighting is in these three sectors. Now, if we look at those three sectors, what we're going to see is each of those three, well, two of the three are definitely in trouble. Here's the XLF. XLF on Friday breaks, confirms bearish, and look at how it's done this, matter of fact. Here was the swing point low. Retest, regen would have been up to this area, and what did it do? It breaks under it, comes back up, test into this retest, regenerate bearish, breaks back down, and now breaks a low. This wants to go lower, and we knew that potentially was what was taking place off that first week of earnings, and we talked about that extensively that first week into how this was setting up. If you look at it on the weekly now, remember it was hanging on to that retest, regenerate bullish on the weekly. Well, it's under it now. If it doesn't get back up here this week, it's going after this high of the low at a minimum, and it's not that far away. So this one is leading us on the way down. That's the financials. If we look at the technology sector, it's right behind. Look at all the swing point lows that are lined up here on this sector. You've got them here, here, here. It just broke this one, right? And it's going after these other two. Volume pressed lower with volume here on Thursday. Reversed, remember it reversed. Now it's coming back. Volume not quite as heavy. It's going to test into this area this week, it looks like. That's another key sector. And if you look at it on the weekly time frame, it too has, this ledge, so to speak, is sitting at that ledge. Even though it doesn't have a swing point low because it actually got lower within these 6 bars, it is doing a retest regen off this high bullish. That low, 39.79, you close at 39.90, so you're right at the point of breaking that bullish retest regen. So in other words, just like financials, if this one doesn't turn and head higher, it looks to me like it's going lower. And on a volume perspective, that looks to be what it's trying to do. Again, October highs of the lows are going to be the targets. And we can look at it, and I say that because that's the sore thumb. You can kind of see it sitting there, right? I mean, huge volume sitting there. If you look at it just from a range perspective and do the range, it's going to get into the bar, into where you see support down here. So, those lows become, the highs of the lows become the target, and it can certainly trade into those, but that becomes the target, the initial target, I should say. The other one is XLV. If we look at the healthcare, now this is a very sloppy chart at this point. And if you think about it from the perspective of what's inside this, part of it's biotech, part of it is, Pfizer, all the drug companies and so forth. The biotech's what's holding this up, like an Amgen, right? That's what's been holding this up. And right now, this one is the strongest of those three. But this one, as you can see, is trying to head back down. It's a very sloppy chart. It's a huge range. As a matter of fact, it's right on the point of breaking the kind of two levels that exist on that range, and it's right there in it, trying to break down into this lower one. If you get into it, you're usually going to try to head to the bottom and test the bottom. So I would expect this test down in this area is going to take place. Now, when you think about it from that perspective, and if you look at some of the other sectors, that's why I'm thinking that if we go back and look at the S&P 500 on the weekly chart, and let me draw this in again, if we take this range, that's kind of the bulk of the range. If we take that and project it down, you can see how it comes into the top of that bar, and you have this area here that is going to shoot for. And the stronger sectors are the ones that are going to try to hold up in this area on their weeklies, whereas the weaker ones are going to try to trade lower. So in other words, I expect that you're going to see the stronger sectors try to hold those higher levels, right at the bottoms of those ranges, like we were just looking at the XLV, whereas the weaker ones all come back deeper and break those lows. And so that's the slight divergence. You have to realize we're in the beginning stages of some sort of a larger decline, potentially. And if it fulfills that way, it will take time. In other words, you don't usually see, it's extremely rare to see a market just cave in and go straight down after just making new highs. It's just not what happens. It takes a while to build. And so I expect if we come down and we do break these, then we're going to find support down here, and that's going to be a buying opportunity. And we'll get into that as we go forward. If we look at the positives, right, I mean, really, there's just the European ECB. Fundamentally, that's really the only positives. There's a lot of negatives continue to build. We've talked about economic data, right? For about 6 months now, it's been getting worse and worse. We're also seeing year-over-year earnings declines now projected for the S&P. This next week's the last big week. It's oil, energy stocks. We're in negative territory here. And so, these projections have continued to decline all throughout earnings season. This is the first earnings season since, I think, 2011 that this has happened again. Something different, right? You're always looking for things that are different. This is definitely different, and something that is definitely worth watching, or recognizing, not so much watching. Greek president, right? Greece elected a 40-year-old leftist, and this guy's making waves, and he's making them in a big way, and he's out there shaking up the EU, and the what is it? I can't think of it. The international body. I can't think of it. IMF. Here it is here, and he's basically saying, hey, we're not going to sit here and just repay you for the next 20 years. We're not going to be a creature like Creature from Jekyll Island. If you haven't read this book, I put a link in. It's kind of expensive. It's a long book. It's like 600 something pages, but a little repetitive at times. But it's a good book. And really, the essence of the book is about how the banking structure works and what the Federal Reserve does. And you see it play out over and over. I mean, we just did it again in 2008, and that is that we socialize the losses from banks through the Federal Reserve, right, giving them money. If you remember Paulson, when he was trying to shove through that $800 billion bailout, if I remember the numbers right, back in 2008 at the end of the year. And if you remember, it failed to get through Congress. And then they came back and pushed it through. And that $800 billion was supposed to go to various things. Well, almost all of it went to the banks, the big financials. It was a bailout. And those bailouts always happen. And the way it works with countries with the IMF is the IMF, if you think about debt and you say, okay, I owe you $200 billion, there's no way I can pay you back, right? Well, I'm going to forgive some of it. I'm going to charge you interest on the rest of it. And I'm going to push that term of the note out. Instead of 30 years, you can pay it back in 50 years. Well, what does that do? That keeps you indebted forever. Because between now and the next 50 years, you're going to have another crisis, and we're going to do it all again. And that's essentially what happens. And this book really, talks about that and a bunch more, but it's a really good book. And if you have time, it might be something you want to put on your list to read. Excuse me. Okay, so So this guy's making waves, and that's going to come to a head. It's going to come to a head very quickly. We also saw some data, the first data point print for February, and it showed contraction now in China, 49.8, under the 50 mark. Economic data still going to be an issue. What to watch for? I think these three things. The Federal Reserve speakers are going to hit the circuit like they always do after the meeting. And I suspect you're going to get a lot of waves, and some of those are going to be positive ones to try to push this market back up. That's what they always do. I expect you'll see it again. These technical breakdowns, if they do not recapture, in other words, come back up, the XLF, the XLK, this market is going to break to the downside. And the swing lows now, if those break, the potential is there, right? The odds favor a faster move to the downside if they break on those multiple time frames. So that's going to be a key thing to watch this week. On the earnings, economic data, I just talked about the Fed. You got the PMIs. You got a lot of data that comes out the first of this week. And you got the last big week of earnings. Most of that's energy companies and some of the laggards. And then retail comes up next week, I believe, for the most part. But a lot of data. All these PMI numbers coming out tomorrow, all throughout the week. And then, of course, the Fed speakers. Geopolitically, the Ukrainian situation hasn't changed. I still think that's going to be a big issue as we go forward because Russia's involved. And right now, the EU, the United States, the others, they're pressing Russia. And Russia's not in a good situation. And usually when you have a bear, back down into a corner, they're going to get violent. And I suspect that's what will happen. What's the bottom line? Well, a week ago, we were thinking there was the potential for a breakout. And if I go back to, say, the NASDAQ, that situation, we were up here, we were over these highs, we were trying to push higher. NASDAQ was looking like it was going to go try to test the highs. And what we were talking about at the time was we need to see the case where the S&P confirms. It didn't. And a lot of times when you get these moves like this that end up being false, you get fast moves back the other way. And that's exactly the way this one turned out. As you know, we've been range trading now for 6 weeks, almost 7. Usually 7, 8, 9 is about the magic number, so we're kind of towards the end of whatever this range is going to be, in terms of which way it's going to break. And when you look at this range, right, this is not a small range. If this does break to the downside and you double that range, initially you kind of got two, well, I've talked about 3 of them before, but you could kind of divide it right about there as kind of 2 equidistant ones. If you project that down, right, that becomes a fairly large drop to the downside, which kind of conveys that other thought that we have on the multiple swing point breaks. So that fast move back down, those swing point lows printing, we've got them all here on the dailies. If we look at any of the others, right, we've got them on the weeklies. We've got them on weeklies with respect to sectors. Things are primed to try to break lower. That's the bottom line. That's the worry. That's the concern. That's why the prudence. That's why you should be careful. If we move over to the portfolio, last week, in anticipation of that potential breakout, we took on some exposure. Didn't work. Had to pull it back off, right? Had to get narrowed, skinny, whatever you want to call it again, down to about 25% invested. Picked up 1 entry with Now last week, but for the most part, avoided buying anything other than adding a little bit to some of the existing positions and taking some profits on them as well. I just want to highlight 2 here. So we're basically down to 7 positions, 25% invested, very narrow. And let's take a look at these 2 that I've got highlighted. Now, ASHR, of course, is the tracker of the Chinese market. We just saw that PMI I talked about going negative. That's putting some pressure on this particular market. And, if I pull up the weekly chart, let me grab that. when I first put this trade on, we realized or we knew that it already made a huge move. We didn't know if it would extend or not, and if the general markets around the world had extended, this of course probably would have extended farther. That didn't work out to be the case. So now it's coming back into first support. We've already put on enough exposure that I don't want to put more on at this level. If it holds here, pushes back up, the rest of the market doesn't look good, then we take some of that off and then try to buy it lower. It can come all the way down and still be bullish, to this low, 29.18. So, when you look at the risk, it's fairly large, right, that this thing could pull back a long way. At the same time, I think there's still potential for this to go higher. This is kind of a normal correction in a larger swing. And so from that perspective, okay, I don't want to just abandon it, especially since I'm not heavily invested. But do I want to get heavier? Do I want to add more? No, I don't. Not at this level, right? It would be at lower levels where we would do that. We have a 4.5% size. If we come down deeper, right, that's where we would add more. If we actually bounce back up and the rest of the world isn't doing anything yet, then we'd probably want to take off exposure and then again try to buy it back. We just want to try to work this trade, and we're going to work it just as I'm going to show you here on the gold trade, which comes up next. If we look at the next one, that's NXPI. Now these guys report earnings, I think Tuesday. They have the potential to break higher. They've been consolidating now, and as you saw, Apple released good earnings. They've been consolidating up here in this range. They're going to attempt, and they did it here on Apple, they're going to attempt to push back up and test this high. If it fails, if we look at these on a weekly basis, if it fails, they too can come back and they can test deeper. And it would still be bullish if they tested all the way back into the $63, $64 range. Well, I don't really want to keep them that low. Matter of fact, I wouldn't want to see them break this swing point low. But you can see that this high 68, that low 69, I think it is 70. That area there is kind of critical. How do you play something like this? Well, we have a good gain in part of it, so we put a higher stop in part of it. As soon as we see what those earnings do. In other words, if it starts to sell off, we're going to just stop out of one of them, maybe keep the other one. I think longer term, it's still a great position to try to be in. But short term, if this market breaks down, a rising tide lifts all boats, a sinking one brings them all down. So you don't want to stay overly exposed in any particular stock when the general market struggles. We want to buy lower, and that's been the case for 3 years, right? If you look at the S&P over a long-term basis, and when we're talking about 2-3 years, there have been no opportunities other than October. There have been no opportunities to try to grab this lower, right? It's been a steady up, 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 up and away. These types of moves here, that's the kinds that you expect to happen occasionally, and I expect we will see it again. I said that last week. Those are the ones that you want to get, you want to be kind of thin going into them, and you want to add to your positions when they start to crater and everybody else becomes fearful. We haven't seen one of those for 3 years. When they come, when it shows up again, that will be the opportunity to really make some money. Until then, you're just trying to stay up with the market, make some money along the way. But the big money is made at those larger moves, up and down. And the rest of the time, you're just kind of clawing away, with a little stuff for the most part. So that's the idea. We'll see if it comes to pass finally, and if we get a larger pullback. I think that's it. So, what am I? I'm not very invested, in terms of size. I'm looking for the potential for a faster move to the downside, which will set up a short-term trade bounce back up probably. And then, if you go back to that S&P chart, and I'm going to look at it one more time with you here on a weekly basis, if we see the push lower into this area, and I'll draw it out here with this, if we see a break, and I'll, from this level, I'm going to bring it over here so I can point it out. If we see this break and give us this kind of move back into this zone, and then we see a bounce, right? This area becomes very hard to get back over, or at least it should. If that's the case, and this looks to fail here, the buys down here are flips up there for the most part, right? On the potential for a test of these lows. A break of this low is a big deal because why? That puts this into a bearish territory. Now this will take a while to play out if it works out that way, more than likely, but that would be a bear on the intermediate term time frame. That doesn't happen very often. And if this lasts long enough, then you really start to threaten the long-term time frames. And that hasn't happened for 5 years. It will at some point. I have no idea if this is it. All I know is those are the kinds of things we have to watch for going forward. Use what the market tells us to stay on the right side of the trade and keep our portfolios at or near their highs and position ourselves for big gains, when those opportunities come. Hope that helps. As always, you can drop me an email if you need, and I'll do my best to keep us out of trouble and to position us for profits going forward. Consistent profitability, that's what we're always after. We don't have to beat the markets on the upside. We just got to stay kind of close. And when we get these big downdrafts, that's when we can really outrun the markets. That's what it's really all about, folks. Have a great one. Thanks. I'll see you next time.